Today is 27th of May 2025. Uh, how to calculate variance of return? You should first calculate expected return, and each of the return you should get the difference and square it, and you should also multiply probability because there's probability, and on your return will be 1 plus on your return equals to 1 plus first quarter and multiply by each quarter, 1 plus each quarter. And excessive return is difference between average return on invest and T-bill, which is risk-free interest. It is similar concept with bonds yield spread. Uh, Common risk is which is correlated, and there will be uncorrelated risk. There's example of diversification and gambling, which is in casinos perspective, when some users do payoff, which is 35 to 1 game, their return is just above zero, and they have very big standard deviation. But you can diversify this risk by using a lot of number of users. So there's comes standard error of the estimate of expected return concept come out. From expected returns standard deviation, we can construct 95% interval, and uh, risk premium for the diversifiable risk should be zero, only awarded for systemic risk, unless it stands for there's arbitrage opportunity. A standard deviation is not appropriate measure of risk for an individual security. To determine how sensitive a stock is to systemic risk, look at the average change in the return of change for each 1% change to return on portfolio that fluctuates fully due to the systemic risk. We can measure it by beta, but the problem of beta is whether uh, the stock increased 100% when market increased 100%, but when it decreased, stock A didn't move anymore, but stock B, in the stock B situation, when market increased 100%, it doesn't move. Market decreased 100%, it decreased 100%. Their stock A and B's beta will be same. We should also think about beta's limitation. The market portfolio is given expected return, minimize risk, given risk, or maximize expected return. What I do is maybe we can use k-mean approach to recursively construct efficient portfolio problem. Yeah, so sensitivity to systemic risk is beta, stock change divided by market change, and beta of market portfolio will be 1 because it divided by itself, and your portfolio higher than 1 is riskier. So if we see the problem together, calculating expected return will be probability multiplied by each of value that they have. And when you calculate the variance, you will calculate return minus expected return square multiplied by probability. And also when you calculate realized return, it is different concept with annual return. So you should calculate from start to end plus get any dividend minus 1. When you calculate variance, you should do 1 over t minus 1. And for diversification, this is the diversification of casino problem from casino's perspective. If you see here, the standard deviation when you calculate it, and you will divide it by number of users. We use concept of central limiter and large number, law of large number, for portfolio from volatility. There's a type S firm and type I firm has different situation. Type S firm have equally like return, then they can calculate return and derivative standard deviation. And for type I firm, they can divide it. Type I firm can standard deviation can be split by number of n. That is the butterfly. And when estimating beta, it will be difference between each of asset and divided by each of portfolio. And for estimating the cost of capital of investment funds. But when you study engineering economics, we use a lot of cost of capital or other discount rate. It is determined by this CAPM formula, which is this RI equals to risk-free rate plus beta multiplied by market risk premium. For expected return and beta, we can calculate this. Thank you.